Perils. Perils are the causes of loss insured against in an insurance policy. Life insurance insures against the financial loss caused by the premature death of the insured. Health insurance insures against the medical expenses and the loss of income caused by the insured sickness or accidental injuries. Property insurance insures against the losses of physical properties or the losses of its income producing abilities. Casualty insurance insures against the losses and damage of property and resulting liabilities. Losses. Losses is defined as the reduction, decrease, or disappearance of value of the person or property insured in a policy caused by a named peril. Insurance provides a means to transfer loss. Exposure. Exposure is a unit of measure used to determine rates charged for insurance coverage. In life insurance, all of the following factors are considered in determining rates: the age of the insured, medical history, occupation, and sex. A large number of units having the same or similar exposure to loss is known as a homogeneous. The basic of insurance is sharing risk among the members of a large homogeneous group with similar exposure of loss. Hazards is conditions and actions that increase risk or probability of loss. Per, Perils. Causes of loss. Loss. Reduction of value. Basic for claim. Insurance. Transfer loss. Protection. A2. Methods of handling risk. Avoidance. One of the methods of dealing with risk is avoidance, which means eliminating exposure to a loss. For example, a person wanted to avoid the risk of being killed in an airplane crash. He or she might choose never to fly in an airplane. Risk avoidance is effective, but seldom practical. Retention. Risk retention is the planned assumption of risk by an insured through the use of deductibles, co-payments, or self-insurance. It is known as self-insurance when the insured accepts the responsibility for the loss before the insurance company pays. The purpose of retention is to reduce the expenses and improve cash flow, to increase control of claim receiving and claims settlement, and to refund or for losses that cannot be issued. Sharing. Sharing is methods of dealing with risk for a group of individual persons or businesses with the same or similar exposure to loss to share the losses that occur within a group. A reciprocal insurance exchange is formal risk-sharing arrangement. Reduction. Since we usually cannot avoid risk entirely, we often attempt to lessen the possibility or severity of a loss. Reduction would include actions such as installing smoke detectors in our homes, having an annual physical detect health problem early, or perhaps making a change in our lifestyles. Transfer. The most effective way to handle risk is to transfer it so that the loss is borne by another party. Insurance is the most common method of transferring risk from an individual or group to an insurance company. Though the purchasing of insurance will eliminate the risk of death or illness, it relieves the insured of the financial losses this risk brings. There are several ways to transfer risk, such as hold harmless agreements and other contractual agreements. But the safest and the most common method is to purchase insurance coverage. A3 eliminates of insurable risk. Not all risks are insurable. As noted earlier, insurance only will insure only pure risks, or those that involves only the chance of loss with no chance of gain. Furthermore, even pure risk must have certain characteristics in order to be insurable. Insurable risk involves the following characteristics. Due to chance, a loss that is outside the insured's control, definite and measurable. A loss that is specific as to the cost, time, place, and amount. An insurer must be able to determine how much the benefit will be and when it becomes payable. Statistically predictable. Insurers must be able to estimate the average frequency and severity of future losses and set appropriate premium rates. In life and health insurance, the use of mortality tables and morbidity tables allows the insurer to project losses based on statistics. Not catastrophic. Insurers need to be reasonable certain their losses will not exceed specific limits. That is why insurers policies usually exclude coverage for loss caused by war or nuclear events. There's no statistical statistical data that allows for the development of rates that would be necessarily to cover losses from events of this nature. Randomly selected and large loss exposure. There must be a sufficiently large pool of the insured that represents a random selection of risks in terms of age, gender, occupation, health, and economic status, and geographic location. A4. Adverse selection. Insurance companies strive to protect themselves from adverse selection, the insuring of risks that are more prone to loss than the average risk. Poor poor risks tends to seek insurance or file claims to a greater extent than better risks. To protect themselves from adverse selection, insurance companies have an option to refuse or restrict coverage for the bad risks, or charge them a higher rates for insurance coverage. A5. Loss of large number. The basic of insurance is sharing risk among a large pool of people with similar exposure of loss, a homogeneous group. The law of large groups states that the larger the number of people with similar exposure of loss, the more predictable actual losses will be. This law forms basics the basis for statistical prediction of loss, upon which insurance rates are calculated. B. Insurers.